most people use their health savings account like a medical debit card. Doctor visit comes up, they swipe the card. Prescription at the pharmacy, they swipe the card. End of year balance, 0. That is the financial equivalent of using a Ferrari to deliver pizza. Technically functional. Completely missing the point. The HSA is, by the math, the single most tax-advantaged account available to American investors. More powerful than the 401k. More powerful than the Roth IRA. And the strategy to maximize it is straightforward, but almost nobody does it because nobody explains it clearly. Today we are going to fix that. Every other tax-advantaged account has 1 or 2 tax benefits. The HSA has 3. This is not marketing language, it is a structural fact of the tax code. Tax Advantage 1, contributions are pre-tax. If you contribute through payroll deduction, the money comes out before federal income tax, state income tax, and FICA taxes, Social Security and Medicare. On a $4,300 individual contribution in the 22% federal bracket plus 5% state tax plus 7.65% FICA, you are saving roughly 35% in taxes on your contributions. That is $1,500 you did not pay in taxes. The 401k gives you pre-tax contributions but not the FICA savings. The HSA beats the 401k on the contribution side. Tax Advantage 2, growth is tax-free. Once your money is in the HSA and invested, all dividends, capital gains, and appreciation accumulate with 0 tax liability. Same as a Roth IRA. Tax Advantage 3, withdrawals are tax-free for qualified medical expenses. Not tax-deferred, tax-free. You pay nothing on the withdrawal if it is used for healthcare. The Roth IRA gives you tax-free withdrawals but only for non-medical expenses. Healthcare withdrawals from a Roth are taxed if they occur before 59.5. In summary, pre-tax in, tax-free growth, tax-free out for medical. The HSA is the only account in the United States tax code with all 3 benefits simultaneously. That is why it is the most powerful account in America. One important requirement: to contribute to an HSA, you must be enrolled in a high-deductible health plan. For 2026, an HDHP has a minimum deductible of $1,650 for individuals and $3,300 for families. If your employer offers an HDHP option, this is worth running the numbers on. For 2026, the IRS allows the following HSA contributions. Individual coverage, $4,300 per year. Family coverage, $8,550 per year. If you are 55 or older, you get an additional $1,000 catch-up contribution. These limits are indexed to inflation and increase modestly each year. For a family contributing the maximum of $8,550 every year for 20 years, the math on what that builds is extraordinary, and we will get to that projection shortly. Contributions can be made through payroll deduction, which gives you the FICA savings, or directly to the HSA provider, which gives you the federal and state tax deduction but not the FICA savings. Payroll deduction is always superior when available. Here is the strategy that most people never implement: do not spend your HSA on current medical expenses. I know that sounds backwards. The whole point of the HSA is medical expenses, right? Technically yes. But there is no rule that says you have to reimburse yourself immediately. Here is the rule that changes everything: you can pay a qualified medical expense today, save the receipt, and reimburse yourself from the HSA years, or even decades, later. There is no time limit on HSA reimbursements for medical expenses, as long as the expense occurred after the HSA was established. This means your strategy should be: pay current medical expenses out of pocket from your regular cash, Keep the HSA fully invested in index funds, let it grow tax-free for 20 or 30 years, and reimburse yourself later, potentially pulling out a large lump sum of tax-free money in retirement to supplement other income. The math on why this works: $8,550 invested this year at 8% returns will be approximately $18,500 in 10 years. If you had spent it on medical bills this year, that growth never happens. The opportunity cost of using your HSA as a debit card is enormous. The practical implementation is called the receipt box method. Here is exactly how it works. Every time you pay a qualified medical expense out of pocket, doctor visit, prescription, dental work, vision care, physical therapy, even certain over-the-counter medications, you save the receipt. Photograph it with your phone. Store the photo in a dedicated folder, a Google Drive folder, or a physical accordion folder labeled HSA Receipts. That receipt represents a tax-free withdrawal you can take from your HSA at any point in the future. You are creating an account of tax-free withdrawals you can access whenever you need them, no time limit, no requirement to use the money now. The IRS has specific guidance that receipts should document the provider, date, and amount. A photo of the EOB, explanation of benefits, from your insurance company works perfectly. Over 10 years of typical medical expenses, assuming $2,000 to $3,000 per year in out-of-pocket costs, you might accumulate $20,000 to $30,000 in documented, reimbursable expenses. That is $20,000 to $30,000 in future tax-free withdrawals sitting in your receipt box while your HSA balance compounds untouched. This strategy is completely legal. It is just underutilized because almost no one explains it. Not all HSAs are created equal. Many employer-sponsored HSAs have limited investment options, high fees, and minimum balance requirements before you can invest. These are terrible for the strategy we just described. The best HSA provider for investors, based on fees, investment options, and usability, is Fidelity. The Fidelity HSA has zero account fees, zero minimum balance requirement to invest, and access to Fidelity's zero expense ratio index funds, including the Fidelity Zero Total Market Index Fund. You can invest your first dollar. Schwab also offers a solid HSA with low fees and good investment options. If your employer uses a provider like Optum, Health Equity, or HSA Bank, you can often do a trustee-to-trustee transfer annually to move money from your employer's HSA to Fidelity's HSA, without tax consequences. You keep using the employer's HSA for payroll deduction contributions, then transfer the balance once a year to Fidelity where it actually grows. The fund to invest in, a broad total market or S&P 500 index fund. At Fidelity, the FCROX, Fidelity Zero Total Market Index, has zero expense ratio. Set it, automate it, ignore it. Let us run the projection for a family maxing out their HSA. $8,550 per year contributed, invested in a total market index fund earning 8% annually over 20 years. Future value, approximately $425,000. Over 30 years at 8%, approximately $1.07 million. Entirely tax-free for qualified medical expenses. Now here is the thing about medical expenses in retirement, they are substantial. Fidelity's annual retiree healthcare cost estimate for a 65-year-old couple is over $300,000 in out-of-pocket medical costs through retirement. Having a dedicated tax-free account to cover those costs is not just useful, it is potentially the most impactful financial decision you can make for retirement security. Here is the second superpower of the HSA that most people do not know. After age 65, you can withdraw HSA funds for any expense at all, not just medical. Non-medical withdrawals are taxed as ordinary income, exactly like a traditional IRA distribution. There is no penalty. This means the HSA at age 65 becomes functionally equivalent to a traditional IRA for non-medical expenses, while remaining a tax-free account for medical expenses. You have the best of both worlds. If your medical expenses in retirement are lower than expected, you simply pull the excess as ordinary income, no worse outcome than if the money had been in a 401k all along. And if your medical expenses are higher than expected, which is statistically more likely, the entire balance can be withdrawn tax-free. The HSA is a healthcare expense hedge that doubles as a retirement account. The complete priority order for tax-advantaged accounts: first, contribute enough to your 401k to capture the full employer match. Second, max out your HSA. Third, max out your Roth or traditional IRA. Fourth, return to the 401k up to the annual limit. The HSA comes before the IRA for most people because of the superior triple tax advantage, especially if you are using the receipt box strategy and planning to pay current medical expenses out of pocket. This account exists in the tax code right now. You can open one today. $4,300 for individuals, $8,550 for families, invested in a zero-fee index fund, growing tax-free for decades. The only requirement is a qualifying health plan. If you have access to an HDHP and are not maxing your HSA, you are leaving one of the best legal tax advantages in America completely unused. Word count: 1, 300 duration, 10-minute end card. Next video: your home is not an investment, the math proves it.